Credit cards are everywhere. We use them for shopping, dining, even booking trips. But how do they really work? More than just a convenient way to pay, credit cards are part of a complex system of credit, interest, and rewards that many of us don't fully understand. At its most basic level, using a credit card means you're borrowing money. Your credit limit is the maximum amount the bank or card issuer allows you to borrow. Each time you swipe, tap, or use your card, you're adding to your credit card balance. This is money you owe the bank, but unlike a debit card, you're not paying it back immediately. At the end of each billing cycle, typically 30 days, you'll receive a statement showing how much you owe and the minimum payment due. If you don't pay off your entire balance by the due date, you'll start accruing interest. This is where credit cards can get expensive. The interest rate on credit cards is called the annual percentage rate, or APR. It represents the cost of borrowing money on a yearly basis, but in reality, it's applied to your balance on a daily basis. For example, if your APR is 20%, you're being charged around 0.055% in interest each day on any unpaid balance. This is why it's always better to pay off your full balance whenever possible. If you only pay the minimum, you'll be charged interest on the remaining balance, which can add up quickly over time. But credit cards aren't just about borrowing money. Many offer rewards like points, miles, or cash back for using them. So, how do these rewards work? Every time you use your card, the merchant pays a fee to the credit card company, usually between 1% and 3% of the transaction. The card company then gives a small portion of this fee back to you as rewards. This can come in the form of points you can redeem for travel or gifts, or as cash back that you can use to reduce your balance. The more you spend, the more rewards you accumulate. Some cards offer higher rewards for specific types of purchases, like groceries, travel, or gas. With all these rewards, you might be wondering, how do credit card companies make money? One of the primary ways is through interest, especially from people who carry a balance from month to month. In addition to interest, credit card companies also charge fees such as late payment fees or annual fees. And don't forget, every time you use your card, the merchant pays a fee, part of which goes to the card issuer. This means the more you spend, the more they earn, which is why they incentivize spending with rewards. One of the key aspects of using a credit card is how it affects your credit score. Your credit score is a measure of your financial health, and it's impacted by how you use your credit card. Paying your bills on time and keeping your balance low relative to your credit limit, this is called credit utilization, are two of the most important factors in maintaining a good credit score. If you're responsible with your credit card, it can help you build a strong credit history, which is important for things like getting a loan or renting an apartment. But if you're not careful, high balances, missed payments, and carrying too much debt can hurt your credit score and make borrowing more expensive in the future. Credit cards are powerful financial tools when used responsibly. They offer convenience, rewards, and can help you build credit. But they also come with risks, especially if you're not mindful of interest rates and fees. The key is understanding how credit, interest, and rewards work, so you can use your card to your advantage without falling into debt. Thanks for watching. Don't forget to like, subscribe, and check out our other videos on understanding the logic behind everyday financial tools.